Here at Plato, we do like to think of ourselves as solution, builders, building solutions to people's problems. Ramsden talked about personalisation. We're building solutions for retirees, for a particular type of investor who want income. They also want growth, though, because retirees are different. They need income to live off. They no longer get a salary. Thankfully, they still get 1.6 million tax-free, and thankfully they still get franking credits after that great election result, which was a lot of relief to a lot of my clients, a lot of your clients too, I think. As Mark said, we structured these products, these things, from the perspective of retirees. In fact, we won a few years ago from Lonsec an award for retirement product innovation, and we're running that product for 8 years now. With that 9% plus income generation, 6%, as Mark said, from our global over just over 3 years. And we actually repackaged our fund into the only LIC that pays monthly fully franked dividends. That's PL8, which has been very successful, particularly after the franking thing. And it's great that we are able to deliver large levels of income because, it just got harder. In the last couple of months, we've seen 2 rate cuts. Most of us probably thought 1.5% was as low as we're going to see the interest rate cycle. Well, now it's 1%. And Bill Evans, who I used to work with at Westpac, is calling another rate cut. So it could be 0.75, could even be 0.5% by this time next year when we do the summit. So it's very tough for retirees. And that just doesn't affect, if you've got your money in the bank or term deposits, but anything that is linked to the cash rate or bank bills have fallen nearly 1% so far this year. So if you've got an income security which is paying you 3% above bank bills, well, actually you're getting 1% less than you were a year ago because bank bills have dropped about 1%. And bond yields, we got to 1.2% in Australia, but we're still a lucky country. France actually issued a 10-year government bond a couple of weeks ago, and you had to pay the French government 13 basis points per annum to get your capital back. Why the hell would you ever want to do that? So it is tough to get that income. And I'm going to show you why you should invest in equities for both income and capital, because retirees do want income, but they need their capital to keep pace with inflation. So let's look at what I like to call the journey of my parents' retirement, journey through time. If you actually look at interest rates, and so cash rates, bank bills we actually use in term deposits, versus the yield on the Australian equity market. Many of you have seen this, but the grey line is the yield on the equity market. It's the All Ords index back to 1980, because that's when they started the index. And it's grossed up for franking after franking came in the late 80s under Paul Keating. And whilst in the 80s, it was a fantastic period for my parents to just put their money in lazy cash. They got 15%. By the time we had the recession we had to have, inflation collapsed, interest rates collapsed, and they've never come back. And now today, we're sitting with equity market yielding around 6%, but we've got cash rates at 1%. The gap has never been bigger in terms of that. The federal, the RBA and other central authorities are making investors look to invest in riskier assets. They want people to make their money work harder. They don't want people to sit in lazy cash. And you're being rewarded for taking on that equity risk. But let's look at the what my parents the outcome they would have got. And these 2 charts are actually interesting because normally people go, the reason we go in equity markets, just look at the accumulation index and how fast it's gone. And this chart and the next chart, we actually split the capital and the income because we are not reinvesting the income. We're looking at it from the perspective of retirees like my parents who spent their dividends or spent their interest to fund their retirement, but they didn't touch the capital because and that's what the typical retiree does. They don't actually draw down the capital, they spend the income. So this is the income from putting $100,000, which is a lot of money when my parents retired, into either the equity market at the start of 1980 or into cash. The black line is the cash income stream, and it was pretty good in the 80s. You would have got 10, 15, even almost 20% at one stage. So you would have got, close to $20,000. But of course, and this only goes to the end of last year, we update it annually, you're now getting about, $2,000 if you're lucky, if you're in term deposits on $100,000, which is not much to live on. But that light blue line at the top there is, and it's hard to believe, maybe a bit hard to believe, but the initial $100,000 put into the equity market in 1980 is now generating about $60,000 worth of income This is cash plus franking, but if you are thankfully a retiree on low incomes, you usually get that franking back, and you still do now after the election result. It was a great period though, 1980. Markets did go up strongly in the 80s. So we've also done three other lines. The grey line is if for someone retiring in 1990, and again we just use the same amount, put 100,000 in the market or cash. The orange ready bar is 2000, put 100,000 again into the market, and the orange yellow bar is putting money in 2008. Now I actually picked those three times because they're not great times. In fact, they're some of the worst times to put money into the equity market, because 1990 was just before the recession we had to have, and for the first 2 years equity markets fell quite heavily. In 2000 was just before the internet bubble was pricked, and equity markets performed poorly for the next couple of years. And in 2008, we probably don't even need to tell the story of 2008, but that was a pretty poor part of the cycle just before the market crash in the GFC. So they're the income outcomes, and in all of those cases you've seen growth in income from the equity market stream. The income is now substantially more than that on cash. It also highlights a bit of volatility, but even in the GFC, that blue line only went down about 20%. Dividends were cut about 20% in Australia in the GFC at the market level. The capital side of the story actually helps explain the income, because what's happened is that initial $100,000 my parents put in the market is now $1 million. And 6% on $1 million is $60,000. If you've invested in 1990, you can see you actually dipped below the cash for initially, but now you've got close to 400,000. And interestingly, update today, market has actually regained the GFC, pre-GFC peak. So actually you've got your capital back if you invested in 2008. But you did get more income along the way. So it highlights the risks, but it also highlights the returns that you get. And I think these are great slides to share with your clients, because they tell you why you invest in equities for growth, capital growth plus income. But we're a high income investor. We actually generate about 3% more. So actually that would be 90,000, not 60,000. But there are some traps to high income investing. You don't necessarily just become an ETF and say, let's buy the highest yielding stocks, because not always the highest yielding stocks are the best. Because I could have bought, and I know we kicked the boot into AMP, but I could have bought AMP on a 15% gross yield towards the end of last year, until it cut its dividend early this year. And then recently, last week, it cut its dividend again this year to 0. So if I'd have bought AMP on a historic yield of 15%, I would now, and I still held it, I would now be looking pretty silly, because not only am I not getting any dividends anymore, but I've also lost quite a lot of that capital. And capital preservation is how we look at income investing. It's not all about income. You want sustainable income, but you also want to actually make capital. We actually go into trades to make both capital and income. Investing in what we call dividend traps, stocks that, the only reason why AMP's yield went up was because its share price went down. The blue line is the share price. And in fact, largely the share price and the yield are a mirror image. If price goes down, the historic yield goes up, unless they cut their dividend, which it actually has. So avoiding dividend traps is key. Diversification is also key to income investing, or any investing really. And we've shown this chart before, but the Australian market is incredibly concentrated. Half of all the income of the ASX 200, almost half of it, comes from 6 stocks. 4 of them are banks, and we know what's happened in Royal Commission and that. NAB's cut its dividends, the others have managed so far to hang on. Telstra is in that top 6 in terms of income, but it's cut its dividends by 48% from 2 years ago. And the other one's BHP, which is the star performer in the last year or two. But if you actually look at those big 4 banks and you look at the Telstra, you can see they have been particularly challenged and significantly underperformed the market in price terms over the last couple of years. So, we actually do invest in the banks. We have held Telstra at times as well, but generally underweight the last year or two. But we have actually outperformed the market in the last 12 months and delivered very strong income. But of course, it's a different story. The world truly is your oyster. If I do the same chart for the MSCI World Index, I took at the top 6 stocks, quite diversified. You won't be able to read the names probably from the back of the room, but there's only one bank. You've actually got Microsoft, you've got Apple in the top 6 income providers. So just looking at the names, much better diversification, and less than 10% of the income comes from those stocks. So truly the world is your oyster. So just in concluding, Income is definitely getting harder and harder every time I get up here. It seems it's getting harder to get. Interest rates at a historic low, which is why probably the market's that high. Equities can provide both good income and growth, and we have a strong track record of providing that income. Thank you for your attention.